Hi, and welcome to the week ahead. My name is Tony Nash. Today we're with Albert Marco and Mike Green. Before we get started, I'd like to ask you to like and subscribe our YouTube channel. Thanks for doing that. Also want to let you know our CI Futures promo ends on April 30th. This is CI Futures, about 3,000 assets forecast every month for $50 a month. That promo will end on April 30th. So if you're interested, please go to completeintel.com/promo and check it out. So this week, we've got some key things from the past week. First of all, Powell's wrecking ball and rate rises and the dollar wrecking ball that comes with that very important item. Tech earnings, we've seen a collapse in tech equities over the past couple of days, not a collapse, but some real interesting activity. We're going to talk through that. And then commodities, we've seen commodities, heard some people say commodities are getting smoked late this week. So let's talk through that. So Mike, first, let's look at Fitcher and Powell is out this week, all but assuring a 50 basis point hike in May. And a lot of people think it may be stronger for a longer period of time, maybe June and July even. I hear a lot of people saying a few weeks ago, it's all been priced in, yet we've seen kind of some panic in markets on Thursday and Friday. So we've got the 10-year on screen right now. So what is new here from your perspective, and why are we seeing the reactions now?
So the point that I would argue on this is that we're in a feedback loop, effectively, where the market tries to price the Fed's indications. The Fed is in turn responding to the market. And so it's leading to a dynamic where the Fed is saying, well, look how interest rates are rising, particularly at the back end. Clearly, we're behind the curve. Therefore, we need to hike more, and we need to convey to the market that we're going to hike more. The market mechanically has to respond to that because you just can't ignore it, right? You have to effectively think of it in a binomial tree type framework. The Fed has told you they're going to hike more aggressively. Therefore, you need to shift the whole system up, right? And that feedback loop, I would argue, is what we're kind of captured in right now. And it's part of the reason why the market is forced to respond to it in a risk-off fashion, et cetera, right? We just don't know if the Fed really actually knows what the underlying signal is and how much of it is us and how much of it is their insights onto the economy. The second thing that I would just highlight is that the Fed has put themselves into the very uncomfortable position of last year arguing that inflation was transitory. And this has been one of these really frustrating things for those of us that actually agreed with them, that it is largely transitory in inflation rate, right? So the rate of inflation is transitory, but the price level, I don't expect oil to go back to negative $37 a barrel. Like that would be absurd, right?
Right.
So when you talk about the transitory dynamic, it's typically thought of as the rate. But I think the perception had broadly been that prices themselves were going to somehow come back down, right, and not adjust to the realities of accommodating the difference. So I think that is sitting at kind of the core of the issue is that the Fed is now, in the same way they were trapped in that transitory framework that people began to increasingly malign and make fun of. Now they feel this overwhelming need to come out and tighten and show that they're actually serious about inflation and reestablish credibility, even as it's very clear that the economy is starting to slow. And they're then forced into the mantra of now saying, well, we see no signs of the economy slowing. And so they're going to have to maintain that for a period of time where they sound like fickle policymakers.
Right.
And I think the market is understandably concerned and scared at how far they're going to have to go to prove to us that they're really serious.
Right. And Yellen was out saying there will be no recession this year, which, I hope she's right, but
guarantees there's a recession. Yeah.
Right, exactly. So I was roasting coffee yesterday, and my coffee guy was telling me that coffee prices will stay elevated because of the buying cycle from the farms.
Yep.
And so, up and down the commodity, supply chain across metals, across crude, across, ags, that timing has a real impact on the change in levels. The rate may not change much from here, but it seems like the level will remain elevated, as you were saying.
I think that's right. And again, that's why the transitory, I think, was so toxic and confusing to people, because they were thinking, oh, we're going back to $1.75 gasoline as compared to the $6 and change that we're currently paying in California, right?
Right.
That's very hard to accomplish, right, under the
Right.
current framework. And the coffee example is a really good one. It's not so much the level, right? The adjustment to the level is painful.
Yep.
Once that level has been reached, all sorts of changes in relative purchasing activity can occur, right? You can decide you're going to roast your own beans because it's cheaper than somebody else's beans, right? You can decide that you're not going to go to Starbucks. You're going to, do your coffee at home and put it into a travel mug to save money, right? Or as the Wall Street Journal highlighted, you can reduce your consumption of beef and chicken and increase your consumption of lentils. And yet another example that just pisses people off because it feels completely disconnected from the reality that they're in. But those are all true statements, right? Those are adjustments that people make once the level settles down. Where the real problem occurs is the uncertainty about the level, right? Is it going to be 20% higher next year? Is it going to be 20% lower next year? That makes it very hard for me to plan.
Right.
And that's really what we've experienced. And now what your feedback, what your contacts are telling you is, no, prices are going to stabilize at a higher level because that's what's required to induce a supply response.
Right.
Okay. Like, sucks. Coffee's more expensive now, but at least it'll be in the stores.
Right. So going down the path of, say, your, Wall Street Journal saying you need to, eat lentils instead of beef. With interest rates rising, it seems like consumers would utilize more credit during that adjustment period. With rates rising, it seems like it would make things much more difficult. So there's a double whammy on consumers. Are we seeing that impact right now?
I don't think we're yet at the point that the higher interest rates are feeding through in a way that matters, right? So the vast majority, something like 95% of outstanding mortgages are no longer adjustable rate. They're fixed rate. And so that is going to be very slow to adjust. We'll see it at the marginal purchasing behavior. And we are absolutely seeing that. We've seen a dramatic reduction in refinancing and purchase applications. We're starting to see traffic deteriorate. We're starting to see new orders roll over. We're starting to see consumer spending intentions begin to plummet. And there's two reasons why people can use credit cards, right? You can use credit cards to smooth over, effectively saying, hey, guess what? I'm getting paid my bonus next week. Therefore, I'm going to make the purchase now and I'm going to repay it. Or you can see people start to tap credit because they're so strained that they can't do anything else. And unfortunately, the evidence that I'm seeing suggests it's the latter, that it's the lower income households who are now taking, quote unquote, taking advantage of high cost financing choices in order to sustain a level of consumption that they're having difficulty retreating from. Like if your rent goes up, and you don't want to be homeless and your coffee prices have gone up, at some point you need to expand your purchasing capacity, and that means using credit.
Well, and in basic terms, what we've been talking about on this show is demand destruction. The Fed is aimed at demand destruction, and that means that demand curve actually moves in, right?
Yeah.
So people are going to have to rein in their behaviors because we're likely at new pricing levels for many things. And so that consumption is going to have to decline a bit to adjust to the new environment. Albert, you had a comment?
Yeah, two comments actually. The thing about the demand destruction and the supply, from the Fed's point of view, they think that getting rid of demand involves eliminating supply, right? So that's a little bit has to do with the rates, but also what Mike said about doom loop. That's very interesting because that's exactly what we were talking about in multiple areas, not just for bonds, but Yellen herself. She's had her minions go out in the bond market and just straight up lie to bondholders saying, oh, they'll recover while everyone keeps buying. And they just keep butchering the long bond. The 30 year has just been, what was it, 3.1 today or 3.15? It's crazy. She did this in 2013 where she had this little ploy where she has, preventing capital flight leaving the United States in order to prop up the U.S. Equity markets, and that's what we're seeing today. And this doom loop between the Fed and the Treasury is because they're not on the same page. They've got different policies, different ideas of how to keep the market, and it's causing problems.
I would actually add to that and just highlight that this is, of course, the downside to not having people who actually, have ever traded or negotiated a swap or done anything else along those lines in positions of decision making. You don't want to put a fox in charge of the hen house, but the reality is it is somewhat useful in terms of understanding what's actually transpiring. And so it doesn't surprise me at all that Janet Yellen says something along the lines of, well, there's no sign of a recession. There's no, because they're working very first order, first derivative type dynamics. It's that second and even potentially third derivative that ultimately conveys the dynamics of what's really happening. And the second part is that the Fed operates under a model in which, negative real interest rates, which is basically a function of inflation expectations and the current level of yield, some people roughly approximate it with trailing inflation and current yields, which is completely insane. But at least if you're doing it in a structural fashion, they tend to presume that the only reason why markets move is due to information, right? That like the market has some insight. And this has been one of the huge policy innovations, and I use innovations in air quotes, over the last 20 years has been this dynamic of, okay, well, if we're trying to figure out market expectations, let's use market inputs. But those market inputs in turn respond to the policymakers, right? So,
right.
And there's all sorts of structural features to markets. If I happen to short a payer swaption, for example, and my risk manager is forcing me to cover that risk, it has no economic signal to it. It's simply a market feature that they're then trying to interpret as indicative of underlying demand. That's just wrong.
Right.
On top of that, you have a political component where Yellen, tied to a certain party, or not just Yellen, others tied to a certain party are going to do things beneficial to that party. I know economists and financial guys don't like to hear that, but I mean that's just the reality of it.
It's the reality of national accounts. So we also mentioned the dollar wrecking ball. So, and we've seen over the past week yen devaluation or yen depreciation. We've seen CNY devaluation. CNY has gone from, I think, 6.34 to about 6.49, which is a dramatic deval of CNY. How much of an impact does the dollar have on those markets particularly? Because we've heard about, the dollar losing influence for the past, 50 years. But talk to us, Albert, what's going on there?
Like I said, Yellen wants, to restrict capital flight, and that, a strong dollar does that. It's killing the emerging markets. They gave Japan the go ahead to devalue the yen in order to offset anything that China does and asymmetrically against the United States, because they've been in a little bit of a tit for tat, for quite some time now. So that's, the dollar at 110 just absolutely annihilates emerging markets, except for the markets that are commodity based, like Canada. I've been in Canada. I love the Canadian economy right now. It's strong, oil based, gold based, so that's where I'm coming from on the dollar right now.
Great. Okay.
Yeah,
Mike,
I would just broadly highlight, but by the way, I don't know if you saw the CNY today, but it moved huge again today. So it's actually now 650. So fantastic in the same way that like a root canal is fantastic, right? But yes, it's a wonderful technology. Nobody wants to experience it, but just to put this in context, this is a move now that is equivalent in terms of devaluation to what we saw in August of 2015 in terms of the much heralded China, right? And so I would just highlight that I think this is an important move. I think it's telling you that there's all sorts of stuff that's going on. I tend to fall into the category of terms of trade dynamics more so than interest rates or even anything, those dynamics. Japan allowing its currency to depreciate, leading to depreciation for the Chinese currency, or contributing to depreciation for the Chinese currency. They are competitive in global export markets, right? So there's an element of China needing to respond and maintaining competitiveness versus the significant devaluation that's occurred in the Japanese yen, which just basically, if you think about it from an American perspective, means I can buy 30% more of what a Japanese worker produces today than I could a year ago. Not quite exactly right, but somewhere in that range. The second part of it, though, is that the terms of trade have just turned so ugly for these countries, where the things that they need to import they have incredible food insecurity. They have incredible energy insecurity. And those are the things that are rising in price. And we're seeing no signs that those are going to retreat, whether it's LNG that Japan now has to compete with China and Europe for from the United States and elsewhere, or whether it's wheat or rice or corn. I mean, I believe, Albert, you may know this better than I do, but I believe Malaysia just announced export restrictions on palm oil, right? They're worried about their own food security. Like, this is the way the system breaks down. And the irony, of course, is that the US, are we going to get unlimited palm oil imports? Of course not. But can we use soybean oil or canola oil in lieu of, palm oil for frying our Twinkies and our food? Of course, right? Like we can do that. The US can survive almost anything from a food or energy shortage standpoint. It's the rest of the world. Albert referenced the emerging markets. I mean, man, if you are
It's tough.
cash crop producing emerging market that is now struggling with issues around food and energy security, this is going to get bad.
Yeah.
Like bad.
It's really bad. It's really bad. It's causing political uncertainty in many regions of the world. And again, we use the phrase doom loop because politicians over COVID policies have created a doom loop in trade.
But let me ask you, and we need to wrap up this topic, but I want to take this full circle because it's fascinating. With the currency devaluation, depreciation in China, Japan, and the food issues, could that potentially push, say, North Asia to put more pressure on Russia to wrap up the conflict so that the commodities out of Russia and Ukraine can alleviate some of this price pressure on emerging markets? Is that a possibility?
It's a possibility, but I think it's a small possibility. Things have changed because of the Ukrainians sinking that battleship. They've got embarrassed at that point. So that's, but interestingly though, now that you mentioned it, I just thought of it. Japan and China have always competed for the fishing rights and then the Sea Japan. So you could see a future, I don't want to say naval skirmish, but a couple boats, taking some live fire rounds.
Sure. Yeah. Or a mistake, right? You could have a mistake that results in something like that. Okay, let's move on to tech. I mean, I think we could talk about this issue for hours.
Oh, yeah.
Let's move on to tech. So Albert, we've spoken about Q2 earnings for a while, expecting them generally weaker, partly on inflation and other pressures. But this week we saw Snapchat miss earnings, but they reported 64% revenue growth. And their active users were up 20%. So their business seems to be going well. Netflix lost subscribers, and we saw them kind of as the tech cautionary tale. Facebook is falling in anticipation of their earnings report next week. On the bright side, Tesla saw a 42% earnings surprise, but their stock, after moving up a bit, really hasn't moved much. So on screen, we've got Facebook and Snapchat kind of showing their downward trajectory over the past month. So can you talk us through kind of what's happening with tech earnings? Is that a rotation? Is that, is tech really out of gas? What's going on there?
I believe tech is out of gas. A lot of it has to do with inflation and rates and whatnot. But I think tech, tech earnings had gone into the stratosphere or when COVID was just blazing because of the lockdowns. I mean, people stayed at home, got on Snapchat, got on Facebook, got on Google and whatnot, right? The Tesla earnings, I mean, those are a joke. I mean, it sounded like Tesla is the most efficient automaker in the world, which is absolutely a joke when they're making cars intense. And it took the market up, like 70 points. And then as soon as some of the better analysts started digging through the information, immediately sold off again, so, and then that actually triggered the market to sell off a little bit because people are worried about, tech earnings. I think Google's gonna miss big. Because their brick and mortar advertising scheme is hurting last month and this month. It's it doesn't look pretty, but I want to take some caution here because everyone's going to get bared up on these tech earnings as everyone's seeing the UOA, big puts coming out there and whatnot. But we've seen time and again, these tech earnings, miss on revenue, and then the guidance is fantastic, and the market, rips 200 points in a week. So I just, I don't want to be short tech at this level right now.
Right. Mike, what are your thoughts?
Well, one, I think, the obvious component is that we've got extraordinarily difficult compares for most of the tech companies, right? So, you go into a pandemic and every kid needs, a computer, every kid needs a cell phone, every kid needs, that. And, I'm speaking to you over a microphone that was purchased during the pandemic, and a computer that was purchased during the pandemic, and a video camera that was purchased during the pandemic, right?
Mm-hmm.
And I upgraded my software, and my kids got new phones, and like all this sort of stuff that all occurred. Well, guess what? It's not happening now, right? And so that's harder. And when I think about the reinvestment that needs to occur, as we talk about going back into the office and into work, et cetera, it's much less on the soft side. It's much more on the simple dynamics of, like, how do we restock a pantry at a company cafeteria, right? Which hasn't had to happen for a while.
Right.
So I am generally skeptical of it. I'm particularly concerned about the consumer side of it. One of my friends many years ago had highlighted that the emergence of cell phones as a consumer good had by and large replaced lots of other types of spending. So it reduced clothes, reduced spending on everything else. Yeah. People are now tapped out on buying those phones, right? They're out of money. And they're using their credit in one form or another. So I'm skeptical on particularly Apple. I agree with Albert, by the way, on Google. I think people are underestimating the importance of the bricks and mortar. And they're also underestimating, I think this is one of the challenges for the Netflix, et cetera, of the world. Like, I'll be 100% straight with you in terms of my household's reaction to it. I mentioned it to my wife. She's like, well, we're obviously switching to the advertising supported model as soon as that becomes available, because candidly, I don't even like watching Netflix to begin with.
Right.
And I could care less if I have to watch ads and get it, for $10 as compared to $20. What that means, and I would argue that this is happening broadly as we move back to a advertising supported model. The inventory of advertising space is about to explode at the exact same time that demand is relatively weak. So who thinks we're going to get premium prices for advertising anymore?
Yeah.
These models are screwy in terms of how badly they could deteriorate if you simultaneously have a boom in advertising space at the exact same time that demand is relatively short.
But lucky us, we get more campaign ads until November. So
exactly.
Okay, great, guys. Moving on to commodities. We saw commodities pretty much get smoked in the last half of this week. We've got a 1 month history of WTI and copper up on the screen. So what happened this week, and what should we be thinking about right now with respect to commodities?
I think that in terms of commodities, I think the biggest component right now is to see what happens in the Ukraine war, whether Russia stops, because every the Europeans and the Biden administration is using that as like the Putin price hike and whatever. Right. But that's what they're blaming it all on. And a lot of people are worried about this being an extended war. I don't think it's going to last more than another month or two. But that's for commodities. It's especially wheat and fertilizer. The moment that Ukraine comes back online, those things will just nosedive. And the Fed wants that to nosedive because they're trying to kill supply and in order to, tackle inflation. So that's from my perspective there.
So a lot of this at this point, you think depends on Russia, Ukraine?
Yeah, that and the dollar, So, the dollar goes up, prices will come down.
Okay. So appreciated dollar, did that hurt commodity prices this week?
I think so. Go ahead, Mike.
Yeah, no, I mean, so they're not quite inverse, but remember, when we see prices, we're seeing our prices. We're not seeing the rest of the world's prices. And exactly to the point that we were raising before with Japan and everything else. On a year-to-date basis, as much as you may think oil prices are up in the United States, they are roughly up 100. They're up maybe 50% in the United States. They're up 100% if you're in Japan. Oil prices are up 100% on a year-to-date basis.
Wow.
Right. That's just an extraordinary outcome. And so, you're looking at these kind of underlying characteristics, and you have to say to yourself, like, the rest of the world is going to start to experience significant declines in aggregate demand. Forget the supply component that Albert is highlighting. Focus much more on the demand. And when we think about commodities, developed world demand is extraordinarily efficient. We don't throw copper on the ground. We don't discard it into landfills. We recycle copper, right? We recycle aluminum. We clean up the sludge off of our factory floors. That doesn't happen in most places around the world, right? Scrap found out in the open is still a significant fraction of aggregate supply. So, we just use it more efficiently. As things shift back here, we're going to become more efficient at it. I got a lot of heat earlier this week for posting a chart that said, look, I'm not seeing this commodity super cycle. I'll say it again. I'm not seeing this commodity super cycle. I don't see the underlying outward shift in aggregate demand in almost any commodity that says, we're going to have truly sustained high levels of inflation and need for significant additional production, other than effectively the disaggregating of supply chains. And, you'll hear things like, huge copper demand because of electric vehicles, right? Like, that is selling human innovation so short. It's just ridiculous, right? I mean, if copper prices go higher, we'll figure out how to use less copper wiring. That's the history of the world.
Right.
That's absolutely correct. I mean, that's when they started using like gold flakes and sprays and different types of adhesives made out of whatever.
Well, it generally takes a big demographic change to enter a commodity super cycle or some sort of supply cutoff, right?
Yeah, I can see like a super cycle within like one or two commodities peaking and then coming back down, and
sure.
Another one peaking and coming back down. But, this like insane super cycle that people were expecting is I don't think it can happen. I agree with Mike on that.
Okay, great. Let's switch gears and look at the week ahead, guys. We talked a little bit about housing, but we've got a bunch of housing metrics coming out next week with Case-Shiller and a few other things. Because of rate rises, do you guys expect to see a near-term impact on house prices? Are we kind of in a wait and see mode? What do you think is happening there?
Politically, the Democrats want housing to come down, right? And I think some of this bond action is meant to do that, to be honest with you. I think they want houses down in the 30-year up. I can't see these housing prices are insane. I mean, it's just, it just stuns me to see some of these homes going for 150% of what they were 2 years ago, and at some point, I mean, the buyers are going to dry up. I mean, these cash buyers are going to dry up, and the credit now, I think in Tampa, it's like over 6% for a 30-year mortgage. I mean, it's going to make it even more unaffordable.
But Albert, Mike, how much of that has to do with housing supply? Are we seeing more supplies coming on the market?
Well, we are seeing more supply of new homes because the delays in completion means that homes that were ordered 18 months ago are finally starting to show up on the market. Mm-hmm. And that's been one of the challenges is that, unlike what we saw in 2005, 2006, this is not a function of massive amounts of new housing being built in areas that previously did not have housing, right? So the character of 2004, 5, 6 was effectively converting farms and semi-rural environments into subdivisions of endless numbers of homes that look identical, so that people could have a home and then drive an hour to their work or an hour and a half to, that was just crazy, and that was killed by the spike in oil prices that occurred with Hurricane Katrina and Ivan. This time around, you just have a shortage of supply in terms of people willing to move, and unfortunately, the increase in interest rates paradoxically can exacerbate that, right? Sure. Because I don't want to leave my house and buy a new house because I have to enter into a new mortgage, right?
That's
I don't have the ability of the mortgage. And so perversely, this could end up preventing supply from coming onto the market, because when I go to look to replace my home, I can't do it. And so it's not clear to me that prices are going to take the hit that people are looking for. I think at the low end, you'll see certainly some pressure on new homes. You'll see some pressure. But perversely, that just exacerbates the problem, right? I mean, if new homes get hit more than existing homes, guess what? We'll get less new homes.
Yep. Okay, great. So far, it's a very positive show, which is fantastic. Yeah. End of a rough week, into a rough show. Let's talk a minute about the French election, guys. It's next week. What do you expect to happen in markets, say with the euro and French equities?
Yeah, actually, we ended up buying the euro today, looking for Macron to win re-election. And everyone that sees my Twitter feed knows I'm a conservative, right? Le Pen is a disaster for France, for Europe, transatlantic relations with the United States. She just can't win, and she won't win. So but the thing is, a lot of people think that she's going to win. So, I think the euro is going to probably pop, 0.5%, maybe even percent come Sunday into Monday. And then the dollar might actually come down, and the market might actually rally a little bit.
Great.
I'm certainly sympathetic to that. I mean, the degree of sell-off that we have seen, everything ranging from the yen to the euro, et cetera, it's hard to sustain this type of momentum. Ultimately, I'm exceptionally bearish on Europe. I'm exceptionally bearish on Japan. For reasons that are largely unrelated to the immediacy of it. I agree with Albert, and I actually would highlight something that he said that is really important for people to understand. When you describe yourself as a conservative, right, most people would say, okay, Marine Le Pen is a conservative, right, because she represents, anti-immigration, and she represents, let's behave more like French people, right? But the reality is conservatism is all about, let's not break the system and try to replace it with some utopian vision, right? Let's try to work within the existing system to make it better. And when you enter into periods of uncertainty like what we're experiencing, there's a reason why the incumbent almost always wins, right? Because people don't want radical change in their lives. It makes it far more difficult. And so I just am not seeing any evidence that Le Pen has the chance that that she's claimed to. And not that I want to join Albert on the potential tinfoil hat conspiracy standpoint, but I agree with him. I don't think she'd be allowed to win.
Okay, interesting. So a little bit of stability in Europe, which is great. Guys, let's have a quick geopolitical lightning round. I know there's a lot going on in Russia, China, Ukraine, elsewhere. What's on your mind, Albert, when you talk geopolitics? What are you talking about the most?
Honestly, China. The civil unrest in Shanghai that's actually looking like it's spreading is really, really concerning. For years, Xi's been holed up in bunkers and can't go. China, Tony. I mean, you have 1.3 billion people mad at you. You just don't go out. And Xi has this problem at the moment. So for me, it's the civil unrest in Shanghai spreading to Guangdong and even outwards.
Wait a second. So Xi has 1.3 billion people mad at him. Did he say something against Bitcoin? Sorry.
That would be 2.3 billion people because all of India is there too.
1.4 billion people, but yeah, exactly. This,
whatever.
You get really mad about that, as I've discovered. No, I completely agree with Albert that and this is again part of the great irony of everything that's been going on, and I'm somewhat guilty of this myself. Looking at the dynamics of Russia and the moves that they were making, and I think both Albert and I would still come to the conclusion says they're going to take Ukraine and they're going to take it in a much more violent fashion because now they're really pissed.
Yep.
But the simple reality is that I think most people had ascribed a degree of competence to Putin and Russia that is now become very clear that the authoritarian and central planning tendencies associated with that style of governance has its flaws, right? People are slowly waking up to this. They're now beginning to see this in China, where it's like, well, wait a second, maybe Xi's not planning for the next 100 years. Maybe Xi's planning for the next 2 days to figure out where to sleep without getting killed.
That's exactly it, Mike. And I've been saying that to people for years. China does not think in centuries. These guys are making it up as they go along. I've been inside the bureaucracy. I know it. They're making it up as they go along. So you hit it right on the head. They're planning for the next 2 days or 2 months. They're not planning for the next 200 years.
Yeah, and the Chinese, they're quite practical, but it's just too big of a country. I mean, there's so many different regions and dialects. I mean, how do you keep something that big, in a cohesive manner? You don't.
It's hard. It's a collection. It's like the EU or, 4 of the EUs, but it's very complex for one guy to manage. So guys, thanks very much for that. I really appreciate it, and have a great weekend. Thank you very much.
All right. Thanks, Tony.
Thank you very much.